Hey everybody, my name is JJ. You're watching BX4, Bull to the Bust, Bull Boom Bear Bust here, back with another dose of economic reality. And we've got some pretty alarming, pretty shocking numbers to go over with you today. What is happening with the economy? Well, things continue to get worse for the average working person. Now, things are looking pretty good for Wall Street, for especially the people at the upper levels of these companies, the ones that are cashing out their stocks. And it's pretty interesting when you look at all the insider selling. A lot of people looked at that as a warning that insiders are getting out. You saw Warren Buffett out there, Bezos, Zuckerbucks out there, all selling big amounts of their own company's stock. So was that a warning because they saw some major danger on the horizon, or were they just taking profits? Well, let's look into the information today, and we'll let you decide. Keep in mind, a lot of these billionaires are building doomsday bunkers. Doomsday bunkers. So you might want to ask yourself, what are they preparing for? We've covered it here on this channel. This is not something I made up. They're actually, look at Zuckerbucks in Hawaii, building doomsday survival bunkers. Right? So the economy is so strong and everything's fine, everything's great. Why build a survival doomsday bunker? Please let me know the answer to that down in comments because I'm still trying to figure that one out myself. Anyway, let's go ahead and get into the news here. And we've got quite a bit to talk about. And, just to paint again the disconnect here, we've got the majority of stocks owned by the top 10%. The stock market is being bought up by those people who own about 92% of all stocks. It's not a sign of consumer strength or strength of the middle class that the stock market is going up. We've got a lot of companies borrowing money and using that borrowed money to buy their own stock. And then the people that work at these companies, a lot of them get stock options as part of their pay, especially the people at the higher levels, and they're raking in a fortune, right? So it's no surprise that we're seeing this type of profit schemes being implemented, into the stock market here. Here we go. Bring up this article here. I just like the way that it's worded right here out of this Market Watch article. Recession red flags. Wall Street and Main Street are at odds about the economy. So what do we just talk about? We look at the consumer confidence surveys, consumer satisfaction in their economy, in the economy, and in their own personal financial situations. And we've got red flags all over the place. The consumers are waving the red flags, saying, this is not good. We're drowning in debt. We're getting further into debt. Now, if you walk around and just look at people, I go shopping, I see what people are doing, and they're not panicking. They're not looking like they're everybody's not in the corner crying and shaking in fear. They're still out spending money. They're still out swiping credit cards. That's what people do. People tend to ignore reality until it's too late. So just when you go out, and because you go out and you see people shopping, swiping credit cards, people lined up at the restaurant, swiping credit cards, doesn't mean that everybody actually feels good or feels fine about the economy. They may feel good about spending money because you can spend money that you don't have in our economic system here, but big troubles brewing in the background. Now, will it be like 2020 where really nothing gets corrected? Right? Think about 2020 where we had complete economic shutdown. Complete economic shutdown. You would expect crashing prices. You would have expected home prices to crash, car prices to crash, the cost of living to crash because so many people lost their jobs, they were out of work. But no, what did they do? There was some massive intervention. And instead of a price correction and falling prices and deflation, we saw massive inflation. And a lot of money created and pumped out into the economy, to the people, to companies, pauses on different types of payments that people had to make, and the rest is history. Now we see inflation. The question is, 2024, is it going to be the same thing as 2020 when everything starts falling apart? Many people think that the banks are going to fail here in March. We've got this bank rescue emergency funding program that they're still talking about. They're going to end this program in March. I find it really hard to believe. So brace for that. I'm not saying it's going to happen, but if it does, you're going to see some major shocks in the economy. The question is, what type of bailouts and how much money creation in the background will they do to come in and quote unquote rescue the system or rescue the banks, right? So it's very interesting time to try to figure out what type of actions are going to take place, right? We know things are over leveraged. We know that things cost too much. We know that there's bubbles in housing and lots of different areas. There's price bubbles, meaning things cost way more than they really should, and it's a debt binge. And if it were not for all the debt and the loans that were taken out, we would not see these high prices and all the programs that were implemented a few years ago, supply chain disruptions, etc. And we've got lots of things happening overseas right now with the supply chains and the supply straits, including conflicts between countries, which are causing more disruptions in shipping. So we'll see how that plays out. But here's what MarketWatch is saying here out of this article. It isn't healthy for Wall Street to be celebrating when so many consumers are gloomy. The U.S. stock market, many of the indices at all-time highs, but there's a disconnect, and that's a good way to put it, from this article. There's a dramatic difference in perspective about the health of the U.S. economy. On one hand, Wall Street is celebrating the stock market's new records, with many believing the Federal Reserve has avoided a recession by executing a soft landing, yet consumers are as gloomy as ever. So you look at all these different surveys, what people are saying and how they're responding is they don't feel good. They don't feel good about what's going on. Again, if you see people out shopping, uh, how many people cry in public because you're in debt and you might not be able to pay your rent? Do you go out in public and cry in front of everybody? I mean, most people don't. They're not going to show it unless you're, maybe drunk and just you've lost control. You're intoxicated, so you're gonna, you know, act like a child or something like that. But most people are not going to show this. So the people that make comments here, oh, everything's fine. I was at a restaurant and people were lined up to eat. Nobody's worried. Nobody's. But look at the surveys. People are worried. People are concerned. They're not going to stop shopping or stop spending money. In fact, it's just the opposite. The more worried and stressed out people get, the more likely they're going to go out and spend money, even if it's money they don't have. I don't know if they call it stress shopping. I think there's a term for it. Is it stress shopping? Is it what do they call it? Shopping therapy, retail therapy. I don't know. Maybe if you know, let me know in the comments. It's not that important, but there is a term for people that go and spend money to make themselves feel better when they're not feeling good. Let's move on here. Some other news I wanted to get into today. Let's talk about the tech industry and the layoffs. Now, we saw layoffs last year up almost double from 2022. It was up 97%. And that wasn't very widely reported. You have to come to alternative media to really see the magnitude of it. But tech layoffs balloon in January. So just like we predicted, things are going to continue to get worse. January started off very bad. You wouldn't guess it by looking at the stock market. You wouldn't guess it by looking at the lines at the restaurant with people lined up to swipe their credit cards, to spend money they don't have. You have to look at the facts. You have to look at the numbers, right? Tech layoffs balloon, Wall Street rallies, lift stocks like Alphabet, Meta, and Microsoft. Interesting, though, that these same companies that are seeing record profits at the same time are laying people off. So they're cutting staff, they're cutting costs at the same time as making some pretty nice profits. So far in January, over 23,000 workers laid off, the most from any month since last March. So almost the worst in a year. The downsizing comes at the same time as investors are becoming more bullish on tech. The NASDAQ is the highest since early 2022. Alphabet, Meta, Microsoft have all reached record highs, yet we're seeing layoffs out of all of these companies have announced layoffs in the past year. So it's not about the companies not making profits. They're making profits. As soon as people stop swiping credit cards, as soon as the credit card companies lower the credit ceilings instead of increasing nonstop or unlimited credit limits or limits on the credit cards, it's the name of the game. If you can continue to go further into debt, you'll continue to see strong corporate profits, right? So one person's debt is another company's profit, all right? Pretty simple to figure out. All right, so we're going to continue to see this get worse. Will there be a reckoning day? Will there be a breaking point? Sure, and it may not come all at once. It may be a slow drip, kind of like we're seeing now. We're not seeing a tsunami of people filing bankruptcy. We're seeing pretty resilient areas, and home prices are resilient. Home prices are staying high, unlike a lot of people expected. But again, they can do a lot of things to keep this propped up and keep people into their homes. And you're going to see in a few months, you're going to see, I think, some very surprising events. And maybe even as soon as March with the whole bank rescue, bank funding program, if that stops here. So, what are we doing here as far as maybe bringing some jobs back? Well, the government's out there spending money basically. Out of Bloomberg here, U.S. aims to announce big grants for chip plants by the end of March. So, this will bring some jobs back. Why don't jobs just come back without the government backing this or without the government paying for it? Why do we have to have grants? Um, because companies really don't want to open up business here because the cost of living is too high. Companies want to open up business where cost is very low for labor. Different countries where you have, ultra cheap labor. The U.S., if it weren't for these grants and if it weren't for the government backing this, you wouldn't have these types of things happen. You wouldn't have chip plants opening up. Now, this is good news because if the chips are manufactured here, maybe things will get cheaper. Maybe not. Maybe it'll be more expensive because the labor is going to be so much more that they'll have to charge even more for the chips versus being manufactured in some country where people are working for scraps. All right, so we'll have to see. But just think about this: if it weren't for the government backing, we wouldn't have these new chip plants coming online here. We also wouldn't have 25% of the jobs that were created in December would not have been created if it weren't for the government jobs that were implemented based on borrowed money, based on deficit spending. Think about this: in a good economy, you would have enough people paying taxes to pay for everything that needs to run, to pay for all the spending. But no, we're having deficit spending, meaning we have to go further into debt as a country just to pay our obligations and just to pay out all these programs that we have to pay out for, including sending money all over the world, including giving corporations loans and backing up the banks. U.S. median rents fell for 8 months now, 8 months of declining rents. So people that say I never have good news, you are wrong. You are incorrect. So this is good news for people looking for a lower cost of living. And 8 months in a row, we haven't seen this in many, many years. But rents as of December were still 22% higher than they were pre-pandemic. So good news, yes, rents are coming down, but we're still way higher than we were before the health crisis there in 2020. The biggest declines were Orlando, Florida, and Austin, Texas. And those are some of the cities that saw huge inflows of people. People loved to flock to Florida and Texas over these past few years for lower cost of living, lower taxes, lower regulations, and some of it was politically political reasons. But now we're seeing these same states with really prices that exploded, and the people in Florida and the people in Texas are feeling like they're still in California because the cost of living is so high in those states now as well. Okay, quick quiz question here for you, the people watching here. True or false? True or false? Try to answer within 5 seconds of when I answer the question. When I ask the question, try to answer in 5 seconds. True or false? The consumer is paying down debt and they're paying it down faster. True or false? You said false. You are correct. Let's bring this up here out of the Wall Street Journal. Credit card debt is up. So debt is rising and it's taking longer to pay it down. They're saying pay it down. They're really not paying it down. They're paying it up. So a lot of people making the minimum payment or even making more than the minimum payment, but the balances are still climbing. So the fact that this headline says pay it down, that's really kind of deceptive because most people are not paying it down. Most people are paying it, but the balances are still going up. So I think they should have said taking longer to pay up because it's still rising. Consumers of the biggest U.S. banks have steadily increased unpaid balances. You notice they put that in the smaller print so it doesn't look as bad. Pretty interesting how they put these headlines out there. So I can see why people are, mixed on what they think's happening with the economy. Here's something pretty shocking right here out of the Hill. Regulators, they want bank ratings to be confidential. It should not be public information. So they don't want you to really know what's happening with the banks. That's why you really don't see a lot of the big business channels talk about what we talk about here. They don't tell you that the banks are insolvent, even though it's true. The banks don't have enough money to cover even a fraction of all the loans that they've given out. And if you factor in their underwater assets and all these loans on their books that are underwater and in big trouble, it's even worse. But just the fact that the banks don't have the money that they loan out, that's bad enough. That's basically insolvency. It's only the way that the system is designed that allows these banks to remain operational. But isn't it interesting, though, that they want to keep this secret? I mean, what does this look like to you? I mean, what happened to transparency? Confidential bank ratings should not be public information. What does that mean to you? To me, that means they don't want to scare the public. They don't want the public to know the true situation with the banks. Let's just see what it goes on to say here. The failure of three multi-billion-dollar regional banks in the first half of 2023 has understandably resulted in a great deal of concern and debate in Congress and among the public. Of course. And what about all the other banks that should have failed that they're just keeping propped up right now, right? So they don't want people to know that. That would cause even more panic, more bank runs, and then the problem would feed on itself. More bank runs and more panic means the banks are even in bigger trouble because they'll have even less money in deposits and more people, scared and pulling the money out of the bank here. Those failures stem from management and directors of those banks engaging in unsafe and unsound banking practices. It's partly true, but they're not really giving you the full picture. All the banks are doing the same type of practice. It's called fractional reserve lending. They make it sound like it's just a few banks and a few people at these banks that weren't doing things properly or within the guidelines. No, it was all in the guidelines. There's no laws against what those banks were doing. The banks that failed, they were not breaking any laws. They were just doing what most banks do, what pretty much every bank does, and it's fractional reserve lending, loaning out money you don't have, and then hoping that people can continue to make the payments long enough to keep everything going. But at a point, things come to a head, and normally you would see banks pull back on the lending like we saw in 2008. We haven't seen that this time because basically we have a guarantee of liquidity, and the Fed even came out and said that several times. They'll do whatever they take. What do they say? I'm paraphrasing here. They say we'll do whatever it takes to keep the public's confidence strong in banking. That's basically paraphrasing, but that's what they said. So in other words, they don't want you to see what's happening at the banks. They'll pump money into the banks, emergency funding programs like we've seen over the past 10 months now, since March of last year, keeping these banks propped up, keeping these banks operational. All right, a couple more things here, and let's talk about rents. Back to rents. We know that rents have been dropping for many, many months. And I just want to pull up a quick chart on this here because it's a good visual, right? You see rents now, you look back to 2017, it was up and up and up. Every year was up higher than the last. This last year was the first year since 2017 where rents were not up compared to the previous year. And you can look to the right edge of the chart here and you see we're now in a downtrend. A downtrend. It's not a crash. You didn't see it fall off of a cliff, but it is a downtrend. And considering all the money being pumped into the economy, this is actually definitely something to go ahead and keep an eye on. All right, let's wrap it up here with a chart. Let me bring up this CPI year over year. And you tell me what you see. Do you see a minus in front of any of these numbers? Do you see negative numbers? No, that means prices are still going up. Now, they're going up slower than they were. If you look at 2022 there, 9%. Of course, things are not that bad. We're only going up 3.4%. But it's not negative, meaning prices are still going up. The cost of living is still going up. So put two and two together. The consumers are deep in debt and going deeper all the time, and the cost of living is still going up, even though it's not as bad as it was. They're not really reporting that as a negative thing, which it actually is. It's not a good thing that prices are still going up. We need a correction. We need deflation. And until that happens, you're not going to see companies want to really open up a lot of new manufacturing here in the U.S. You have to have the government backing, like the chip makers backing the opening of these plants of these chip companies manufacturing here. So will it bring back some jobs? Sure. Will it solve the problem? No. cost of living is still going to continue to go high until the money stops being pumped into the system, until people can no longer swipe cards and go deeper into debt, and until they can't just create more money out of thin air. We're going to continue to see inflation rise. So we need a freeze up or a stoppage of the issuance of credit, aka debt, in order for this to stop. People keep comparing what's happening now to 2008. No, things are very different. In 2008, there was panic at the beginning in the banks. The banks stopped lending for a few months because they didn't know that there was going to be all these rescues and all these bailouts. Now the banks are pretty confident that it's going to be endless bailouts. That's why I continue to see inflation rising. People that say I called for a deflationary crash, they're crazy, they're insane. I haven't said that in years, because we see what's happening with the banks. They're being propped up. What's going to happen in March? Will all that change? You let me know down in the comments. Otherwise, I see more inflation, more rising costs. You're going to see some corrections here and there, but overall, it's going to be more rising costs. So brace for it, folks. This way you can navigate this. We're all going to navigate this together. And I think we'll be just fine coming out on the other side, because we know what's coming. We're ready. We're prepared for it. And we'll be dancing and singing while everybody else is maybe crying in the corner. All right, people. Thanks for being here. Hope you're having a good weekend. We'll talk to you very soon. Bye for now and peace.